If someone gave you $1,000 today and told you to invest it in crypto, what would you do? Most beginners make the same mistakes. They either put everything into one coin and hope for the best, or they get overwhelmed by thousands of options and do nothing at all. Both approaches are wrong. Here is the truth: building a successful crypto portfolio is not about picking the next 100x coin. It is about having a clear, structured strategy that protects you from losing everything while still giving you the chance to build real wealth. In this video, I am going to show you exactly how to build a crypto portfolio from scratch in 2026 step by step, using the same frameworks that institutional investors like Fidelity and VanEck use. Whether you have $100 or $10,000, this guide works for everyone. Let's get into it. What is a crypto portfolio and why do you need one? Before we start building, let's understand what a crypto portfolio actually is. A crypto portfolio is simply your collection of different cryptocurrencies chosen with a clear strategy to balance risk and reward. Think of it like a team of players. You wouldn't build a sports team with 11 goalkeepers. You need different players in different positions: defenders for protection, midfielders for balance, and attackers for scoring. Your crypto portfolio works the same way. Now, why do you need a portfolio instead of just buying one coin? The answer is one word: diversification. Crypto is one of the most volatile markets in the world. Even Bitcoin, the most established cryptocurrency, has dropped 80% or more multiple times in its history. Individual altcoins can drop 90% or even go to zero completely. Diversification works by reducing the impact any single asset can have on your total portfolio value. If Bitcoin drops 40% but you also hold Ethereum, a DeFi token, and stablecoins, the damage to your overall position is cushioned. The goal is not to eliminate risk. That is impossible in crypto. The goal is to make sure one bad investment does not destroy everything you have built. A good rule of thumb is to limit cryptocurrency to between 5% and 10% of your overall investment portfolio at most. This means if you have $10,000 in total savings, putting $500 to $1,000 in crypto is a sensible starting point. Step 1. Know your risk tolerance before buying anything. The very first step before buying a single coin is understanding your risk tolerance. Ask yourself 3 honest questions. Question 1. How much can you afford to lose? Never invest money you need for rent, food, or emergencies. Crypto can go to zero. Only invest money you are completely okay losing. Question 2. How would you react to a 50% drop? Can you hold through a 30% portfolio drawdown without panic selling? If the answer is no, choose the conservative profile, because the market will test you. It is not a question of if, but when. Question 3. What is your time horizon? Short term means less than 1 year, medium term is 1 to 3 years, and long term is more than 3 years. Shorter horizons require lower altcoin exposure and higher stablecoin reserves. Based on your answers, you fall into one of 3 investor profiles. Conservative investor. You cannot handle big losses. You want slow and steady growth. You should keep most of your crypto in Bitcoin and Ethereum, with very little in altcoins. Balanced investor. You can handle some volatility. You want a mix of stability and growth potential. You are comfortable with a mix of large caps and selected altcoins. Aggressive investor. You are young, you have a long time horizon, and you are chasing high returns. You are okay with big swings. You can take more risk with altcoins. Knowing your profile is the foundation of everything. Build a portfolio that matches your personality, not someone else's risk tolerance. Step 2. Build your foundation with Bitcoin and Ethereum. Once you know your risk profile, it is time to start building, and every solid crypto portfolio starts with the same foundation: Bitcoin and Ethereum. Why Bitcoin? Bitcoin is the most established, most trusted, and most liquid cryptocurrency in the world. As of May 2026, Bitcoin's dominance in the total crypto market stands at 58.8%, meaning more than half of all crypto money is in Bitcoin alone. Bitcoin hit its all-time high of $126,198 in October 2025. As of early May 2026, it is trading around $80,000. Update with latest price when you record. Still holding strong despite market volatility. Fidelity Digital Assets found that allocating just 2% of a traditional portfolio to Bitcoin improves annual retirement spending capacity by 1 to 4%, while increasing loss risk by only 0.5 to 1 percentage points, a highly favorable trade-off for long-term investors. Bitcoin should be the largest single holding in your portfolio no matter what your risk profile is. Why Ethereum? Ethereum is the backbone of decentralized finance, NFTs, and Web3. It is the second largest cryptocurrency by market cap and the most actively developed blockchain in the world. Ethereum is the leading smart contract platform and the backbone of DeFi, NFTs, and Web3. Its robust ecosystem, ongoing upgrades, and massive developer community make it an essential core holding for exposure to the innovation layer of crypto, both Bitcoin and Ethereum warrant permanent core positions in any serious long-term crypto strategy. Neither should be eliminated without strong, data-backed justification. How much to allocate to BTC and ETH? A sound 2026 crypto portfolio allocates 60 to 70% to Bitcoin and Ethereum as core holdings. This is your safety net. This is the part of your portfolio that has the strongest chance of recovering from any crash. Step 3. Choose your portfolio allocation based on your risk profile. Now let's look at 3 specific portfolio models for 2026. One for each investor type. Conservative portfolio for low-risk investors. This portfolio prioritizes safety and stability over high returns. Bitcoin, 40%, your primary store of value. Ethereum, 30%, stable, proven, essential. Stable coins, 20%, USDC or USDT. This is your cash reserve for buying dips. Large cap altcoins, 10%, Solana or similar top 10 coins only. This model has an expected annual return of 10 to 20%, with relatively low volatility compared to more aggressive strategies. This is the portfolio for someone who wants Bitcoin exposure without the stomach-churning volatility of altcoins. Balanced portfolio. For medium-risk investors, this portfolio balances stability with growth potential. Bitcoin, 30%, Ethereum, 25%, large-cap altcoins, 25%, Solana, XRP, BNB, divided among 3 to 5 coins, stablecoins, 10%, mid-cap altcoins or DeFi, 10%. This balanced model targets returns of 20 to 50% annually, with medium risk. This is the most popular portfolio structure for everyday investors in 2026. Aggressive portfolio for high-risk investors. This portfolio swings for the fences, high potential returns but high potential losses too. Bitcoin, 20%, Ethereum, 20%, mid and small cap altcoins, 40%, carefully researched projects in AI, crypto, RWA, DeFi, speculative plays, 20%, new projects with high upside but also high risk. This portfolio can generate extraordinary returns in a bull market but can also lose 70 to 80% in a bear market. Only choose this if you are young, have a long time horizon, and can truly afford to lose everything you put in. Step 4. Use dollar cost averaging to build your position. Now you know what to buy, but the next question is when and how to buy. The answer for beginners is simple: dollar cost averaging, or DCA. DCA means investing a fixed amount of money at regular intervals regardless of the price. For example, every Monday, you invest $50 in Bitcoin. Every Monday, you invest $30 in Ethereum. Every Monday, you invest $20 in your chosen altcoin. It does not matter if the price is high or low that week, you just invest the same amount every time. Dollar cost averaging is the single most beginner-friendly crypto investment strategy. It removes the pressure of timing the market and builds your position steadily over time. Why is DCA so powerful? When prices are high, your fixed amount buys fewer coins. When prices are low, your fixed amount buys more coins. Over time, this averages out your purchase price so you are never buying everything at the absolute worst time. Bitcoin DCA has historically returned extraordinary gains for patient investors. Buying Bitcoin at the December 2018 bottom returned over 2,000%, while the November 2022 entry yielded nearly 600%. The key to DCA is consistency. Set it up, stick to it, and do not stop just because the market is down. In fact, market downturns are when DCA works best for long-term investors. Step 5. Keep your crypto safe. Building a portfolio is only half the battle. Keeping it safe is just as important. Here are the 3 golden rules of crypto security in 2026. Rule 1. Not your keys, not your coins. When you keep your crypto on an exchange like Coinbase or Binance, you do not truly own it. The exchange does. If the exchange gets hacked or goes bankrupt, your crypto can be lost. This is exactly what happened with the FTX collapse in 2022, when millions of users lost their funds. Overnight, the solution is to move your crypto to a personal wallet where only you hold the private keys. Rule 2. Use a hardware wallet for long-term holdings. Hardware wallets eliminate counterparty risk entirely by keeping your private keys on an air-gapped device that never exposes them to the internet, whether you hold $500 or $500,000 in crypto. A hardware wallet is the single most effective step you can take to protect your investment. The two most trusted hardware wallets in 2026 are Ledger, sleek design, wide coin support; Trezor, fully open source, highly secure. For beginners investing under $1,000, the Trezor Model 1 offers unbeatable value with fully open source firmware that any developer or security researcher can audit independently. Rule 3. Never share your seed phrase. Your seed phrase, usually 12 or 24 words, is the master key to your crypto wallet. Anyone who has it can access and drain your entire wallet instantly. Never share it with anyone. Never type it into a website. Never take a photo of it. Write it down on paper and store it somewhere safe, like a fireproof safe at home. Step 6. Rebalance your portfolio regularly. Once your portfolio is built, you cannot just set it and forget it forever. You need to rebalance it regularly. What is rebalancing? Let's say you started with 40% Bitcoin and 30% Ethereum, but Bitcoin had a massive rally and now makes up 60% of your portfolio. You are now overexposed to Bitcoin, which is riskier than your original plan. Rebalancing means selling some Bitcoin and buying more Ethereum or other assets to bring your portfolio back to your original target percentages. Conduct a full portfolio review at minimum once per quarter. Supplement this with threshold triggers if any asset drifts more than 10 percentage points from its target weight. Rebalance immediately regardless of calendar timing. Avoid weekly rebalancing. The transaction costs and tax events compound faster than the marginal benefit justifies, particularly in jurisdictions that treat each rebalance as a taxable event. A simple rebalancing trick for beginners. The simplest rebalancing method is not selling, it is directing new contributions toward underweight assets. If Ethereum has dropped to 10% of your portfolio, put your next few DCA purchases into ETH instead of Bitcoin until the balance is restored. This approach avoids triggering capital gains taxes on profitable positions unnecessarily. Top mistakes to avoid when building your crypto portfolio. Now let's talk about the most common mistakes beginners make so you can avoid them completely. Mistake 1. Putting everything in one coin. This is the #1 beginner mistake. Even if you are extremely confident in one coin, never put 100% of your crypto investment into a single asset. Diversification is not optional in crypto, it is essential. Mistake 2. Chasing hype and FOMO. When a coin goes viral on social media and everyone is talking about massive gains, the worst time to buy is usually right then. By the time the hype reaches you, early investors are already selling. Stick to your plan. Ignore the noise. Mistake 3. Over-diversifying. Over-diversifying is just as dangerous as under-diversifying. Holding too many assets, especially correlated ones, can water down gains and complicate management. For beginners, 4 to 6 assets is enough. You do not need 50 different coins, most of them will move in the same direction. Anyway, mistake 4. Panic selling during crashes. Crypto crashes are not rare, they are a regular part of the cycle. Bitcoin has crashed 80% multiple times and recovered every time to new all-time highs. The investors who lost money are the ones who sold at the bottom. The ones who held or kept DCNG are the ones who built real wealth. Mistake 5. Leaving crypto on exchanges long-term. As we discussed, keeping large amounts of crypto on an exchange long-term is dangerous. Always move your long-term holdings to a personal hardware wallet. Conclusion. So let's quickly recap. Here is exactly how to build a crypto portfolio from scratch in 2026. Step 1. Know your risk tolerance. Are you conservative, balanced, or aggressive? Step 2. Build your foundation with Bitcoin and Ethereum. They should make up 60 to 70% of your crypto holdings. Step 3. Choose your allocation based on your risk profile. Use the portfolio models we shared today. Step 4. Use dollar cost averaging. Invest a fixed amount regularly regardless of the price. Step 5. Keep your crypto safe. Use a hardware wallet and never share your seed phrase. Step 6. Rebalance every quarter. Keep your portfolio aligned with your original targets, and remember, avoid the common mistakes. No FOMO, no panic selling, no leaving your crypto on exchanges long term. Building wealth in crypto is not about getting lucky, it is about having a plan, sticking to it, and thinking long term. As of May 2026, the total crypto market cap stands at $2.76 trillion, Bitcoin. Dominance is at 58.8%, the institutions are in, the ETFs are approved, the infrastructure is built, the opportunity is real but only for investors who approach it with discipline and strategy. If this video helped you, please hit the like button and subscribe to the Crypto Skill for more beginner-friendly crypto education. Drop a comment below. How much are you planning to start with? Let me know. See you in the next video.